All right, everybody, what I want to do is go over closing costs and understanding them. What's going on here? So oftentimes I'll get a question, hey, I'm making an offer, should we try to get the sellers to pay closing costs? And if so, for how much, right? That's a great question. Um, the answer that I will give is really what I would say to anybody, which is get as much as you can, okay? Because we'll use them. We'll use all the closing costs that you get from the sellers to get you a better deal. It's not like our fees go up or anything like that. It's to help you get the lowest rate possible. So obviously, the more costs you get, the better. Now let's dive in to try to answer that question a little bit better, though. Okay, you have two different types of costs when you talk about closing costs. You have your closing costs, which are our fees, title fees, appraisal, and prepaids for like taxes and insurance. Those are kind of the main set of closing costs. And then you also have your interest rate dependent charges. Okay, so obviously the higher the rate, the less fees. In fact, you can get a credit, and the lower the rate, the higher the fees. Okay, so I have this little flyer here that I created to try to visualize and help understand things. Okay, so right here you can see, hey, closing costs, which are technically divided into kind of two sections here too, which are like, again, your hard fees, which that's going to range about $3,500. Okay, now this is based off of a $500,000 purchase price with 20% down, so basically a $400,000 loan amount. Okay, now you're going to have about $2,000 in escrows too, so that's going to make your total kind of base costs, okay, about $5,500. Okay, now again, that'll vary depending on the loan amount. So a little bit higher loan amount is going to be a little bit higher, lower loan amount is going to be a little bit lower than that, but that gets you kind of an idea. Okay, now that's not your only cost though, right? Because that's for just a par rate. Okay, so now you're going to have over here your interest rate costs. Okay, and interest rate costs are going to depend on, again, which interest rate you want to do. Obviously, like I said, the lower the rate, the higher the costs. Okay, now I have a screenshot here of all the different rates based off of that day's pricing. Okay, and rates do change daily. Okay, so quoting you something today, tomorrow, even this afternoon, it could be different. Okay, but ideally this gets you that idea. So you can see you could do a rate of 5.875, but the cost for that rate is about 20 grand. Okay, or about 5 points. You could also do a rate of 8.25. And then that actually gets you a little bit of credit, so $2,600 in credit, which means essentially instead of your closing costs being $5,500, they would be $2,600 less. Okay, so which rate should you do? That depends largely on how long you're going to keep this loan for, where we think interest rates are going to go, that kind of thing. Normally, though, we kind of look at the rate sheet and say, hey, based off of this, probably somewhere down, around the point range is kind of a typical estimate for closing costs. Okay, so in this example, if we did a rate of 7.375, you can see that cost is about 0.88. So of the loan amount, so that'd be $3,500. So in this case, if somebody came to me and said, hey, what are closing costs? What should we have the sellers pay? Well, we would say 5,500 plus, in this case, about 3,500. Okay, so you're looking about 9 grand, right, for total closing costs in that scenario. Okay, now again, they could be higher. They could go quite a bit higher and stuff like that. They could go lower. It just kind of depends on what you want to do. So the question is, hey, how much should we get from the sellers? Again, as much as you can is the answer. Okay. Now, quickly, let's talk about temporary buy downs. This is another thing you can do. So what I'm showing you here is a permanent rate buy down. Okay, so if you pay this in closing costs, that rate is that forever. Okay, for as long as you have the loan, basically. Now, if you're looking at a temporary rate buy down, you could do this. Let's say you did a rate of 7.625, so you had $1,700 in extra costs. Then you want to buy it down for a year. Okay, so that would be to 6.625 for a year. That's going to cost you an additional $3,300. Okay, if you want to buy it down to, for 2 years, okay, then that's going to cost you almost 10 grand. Okay, so that would go from 7.6 to 5.6 the first year, and then 6.6 the second year, and then after that it's 7.6 normal. Okay, so this is extra costs you can add in, again, if you want to do what's called a temporary rate buy down. Okay, so this would be a permanent rate buy down, and then these would be your base closing costs. Okay, hopefully this helps you understand a little bit better on closing costs and understanding them and how they, coincide with interest rates.